Hello and happy Rate Cut Tuesday. It is Tuesday, March 3rd. Currently it is about 12:30, and I want to give you a couple of quick updates. I'm going to try and make this short and sweet, which I understand for me sometimes is a struggle. But so what happened today? The Fed came out with an emergency panic, I believe, 50 basis point rate cut. They cut interest rates by 0.5%. I've said before a number of times on these videos that one of the things that the Fed has done or been doing is be behind the curve, as identified by the two-year Treasury. So the two-year Treasury right before the Fed rate cut this morning was at 0.82%, and right after the rate cut, the two-year Treasury dropped to about 0.76% and has been falling since then, albeit a little bit slower. The equity market shot up real quickly. Amateurs were likely deciding to buy because in the past, every time the bell rang, the proverbial Pavlov's dog scenario where the Fed cuts rates and stocks automatically go up, everybody decided to attempt to buy that, and then the pros did what they do best, the opposite of the herd, and they sold into it, and the equity market got hammered and continues to. So here we are at 12:30 on March the 3rd. And currently equity markets, just to give you a quick update, are off. Dow's down 2.8% or 744 points. The NASDAQ is off 2.8% or 252 points. S&P 500 is currently down 2.6% or 80 points. So what does that mean? It just simply means that yesterday's strong upside move and today's rate cut does not mean that the bottom in the equity market has been placed yet. Friday's panic low may be a bottom, but I don't know that it's the bottom. And we have to respect the fact that if we in fact are going to have a bottom in place and we have a functional investable rally, it's going to come on the heels of an institutional upside volume event, right? We call it an upside day. We want to see 90% upside day or back-to-back 80% upside days where the 90% of the day's volume are in advancing stocks, or for 2 days back-to-back, each of those days, 80% of the day's volume are in stocks that are advancing. So we have an environment right now, and I want to be very, very clear on this. We have an environment right now where the market is providing conditions that are not completely unfavorable for a crash. Now, what do I mean by that? When's the last time that the Federal Reserve gave us a 50% emergency rate cut, or a 50 basis point, 0.5% emergency rate cut? October 2008. When's the last time we've had a really strong, 5% or so upside move like what we had yesterday? October 2008. Not good reference points for those who are long this market. That's not to suggest that Friday's low is not the bottom. That's not to suggest that Friday's low doesn't hold. It's just to suggest that we are in for some volatility for the foreseeable future. And this market is clearly telling the Fed what you've done is not even close to enough. Well, here's the problem. If the Fed comes in and starts cutting another time, 3, 4, 5, 6 times, what that does is it shows the market that the Fed is, one, admitting that they're behind, and two, they're attempting to play catch up. And in every instance where we've had that kind of scenario in the past, the market has had problems. Let's not forget 2001. The Fed had an emergency full 1%, 100 basis point rate cut, and the market basically went straight down after that. So what have we done? What are we doing? We are waiting for that institutional upside volume event, either 90% upside day or two back-to-back 80% upside days. And by comparison, yesterday, even though the market was up 5%, we only had 79% of the day's volume in advancing stocks. With the kind of percentage move to the upside the market gave us, you would have thought that we would have seen a much, much stronger move in terms of total volume on the upside, and we didn't get it. So by comparison, let me share with you my screen real quick, and I just want to compare with you for reference sake an example of what things looked like back in December of 2018. December 26th, right after the panic low on December the 24th, was a 96% upside day. January 4th followed it up with a 95% upside day, and on January 9th we had something called a breadth thrust or breakaway momentum. That is the kind of environment that you want to see, or you would anticipate to see, that gives us a reasonable estimate that the all clear has been provided, has been sounded. And we're not there. And so therefore, we're going to remain disciplined. We're going to stay in a position of cash and 7 to 10 year treasuries. So let me share that with you real quickly. 7 to 10 year treasuries via an exchange traded fund, IEF. This is where we are here today. There was a possibility that with a Fed rate cut that came in, we anticipated the Fed would in fact cut rates. We had hoped that we would see at least a 0.75% move, which would get that 2-year treasury in line with the Fed funds rate, or at least a little bit closer. Honestly, the Fed could have cut a full percentage point and gotten itself ahead of the curve, but they didn't do it. The market is screaming for more, and the problem is that in our estimation, they're probably going to be late. And if they're going to be late, it's going to create an environment where the economy could clearly start to slow down. If we start to see layoffs or firings start to increase, that obviously would have an impact on consumption. We still don't have any idea to what extent this coronavirus is going to impact the supply chain. I know the Fed's using that as their cover for why they cut rates the way that they did, but I think that we are already experiencing a certain degree of slowdown economically, and they're just not willing to acknowledge it fully yet, which is unfortunate. So that's fine. As I said, we currently sit 30 to 50%, depending upon the type of account you have in this. 7 to 10 year treasuries will remain there for the time being. A few days ago, we also had some investment grade corporate bonds for those portfolios that we are managing that have some bonds as a core portion of their portfolio, much more conservative types of accounts. And we decided to unwind the investment grade corporates, and let me show you why. The example I'm going to have here is symbol LQD, which is an investment grade corporate bond exchange traded fund. And this up here is price. This down here is RSI. Price had continued to escalate while RSI was dropping off. And when you get a price escalation with an RSI dropping off, that's what we call a negative divergence. And in most cases, when negative divergences happen, the price ends up getting resolved on the downside. Well, here you could see the price was for 2 days back to back resolved on the downside with some very, very heavy volume. This was February the 27th. The stock market on February the 27th put in a 93% downside day, a day in which the stock market was off 4.42%. And so sat back and said, I don't like it when stocks and bonds have a 1-to-1 correlation. In other words, they're doing the same thing. By comparison, let me show you LQD and what it looked like back in 2008, which again, I understand there are some differences from now to 2008, but look at what took place with LQD in 2008. You know, clearly we saw a drop off in bond values. There's a 20% reduction in just a couple of months' time. That's a monthly view on this chart. And so we decided the risk of holding investment grade corporates in an environment where there's some similarities to what we saw in 2008 in terms of massive amounts of debt and leverage. It's just a week and a half ago that hedge funds were positioned net long. In other words, they were all in the market to the extent of the 95th percentile. They had borrowed piles of money and bought equities just to be all in. It's not that long ago. And so they're still, to some extent, highly levered for those who have not had to unwind and get into margin call type territory. But nevertheless, we decided that it was a good idea to be safe and not sorry and unwind LQD on a drawdown after having a negative divergence and a 1-to-1 correlation of stocks to bonds on a really, really bad day in the stock market. And then, of course, here we are today with the Federal Reserve cutting rates and investment-grade corporates are on a tear. Oops. That does happen from time to time, but as I said, I would rather be safe than sorry and not participate as best as we can in something that potentially could have a tremendous amount of volatility. We continue to look for a 90% upside day or back-to-back 80% upside days. If we don't get that, we're not going to participate on the long end being invested in equities, and we're not going to until we get that. Typically, if we have a panic low like we had last Friday, you get a test 3 to 4 days later. So let's have a presumption that that happens tomorrow or Thursday. If we do not get a very strong up move in the stock market after a test of those lows, it also is not unlikely to see a retest of those lows 3 to 4 weeks out. What am I saying? I'm saying this market's going to give you a handful of volatility for the foreseeable future. It is not normal that 5% upside days in the market happen. As I said, the last time we seen anything like this was October of 08. Not to suggest that this market's going to turn into an 08, but I do want to caution you on the fact that this market is providing some characteristics that are not too incredibly dissimilar to other environments with markets who have gone through a crash. And if you think about the February 19th, 2020, just a couple of weeks ago, high that was put in the equity market, a 20% drawdown from there would take us to about 2,700 on the S&P 500. We're only halfway from where we currently are to that low. So if the market were to crash, we're already halfway there to some extent. That's one way to look at it. Not saying it's going to happen. I'm just saying that there are characteristics that it could provide conditions of favorableness of that kind of a situation. The market's not happy with the Fed. They're not happy with this kind of a rate cut. The Fed is behind the curve. They're going to have to continue to cut if they want to catch up. And the real negative is if they continue to cut, which we believe they will, it's an admission to the market that they're behind and therefore something's wrong and the economy is in fact slowing, which creates a problem. So therefore, caution is the word. I'm putting that out there for those of you who have assets that are away from our firm that we're not managing for you. If you're current heavily long in things that are cyclical in nature like tech, of course, you want to be careful. The things that are working right now are treasuries, gold, utilities, staples to some extent. If you have to be invested in equities, we don't. We want to be cautious, protect the gains that we have, and try to provide them as much as possible away from the volatility of the equity market until we get that all clear. So my caution to you is just be prepared for either some serious downside volatility or prepare yourself with an exit strategy, or if you want some help on identifying some levels that you might experience and how you could react to those levels, let me know. By all means, I'm here to help you in any way that I can. We're going to continue to be vigilant on this side. If you want to chat, I always welcome it. 608-354-1977. Email chris@careformywealth.com. Hang in there. We'll get through this. Everything will be fine. We are not participating in this current equity mess. We are, as I said, 30 to 50%, 7 to 10-year treasuries, and the rest is cash, waiting for that opportunity for a confirmation bottom by way of some institutional volume event that I've explained. If there's anything else you need, by all means, let me know. Until then, I hope you have a wonderful, peaceful day. See ya.